I've laid out for you the arguments that I think are made by the studies that there is this 88 basis point advantage, this presumption that's out there in terms of the systemically significant firms. And I think that the studies of the FDIC show the same relative
They do, absolutely.
magnitude. So to go back to the markup or the conference committee, I put forward several amendments to try to overcome this tendency. One in particular required the FDIC to estimate at the outset of the resolution process what creditors would have received in bankruptcy,
Right.
and limit payment to bankruptcy less a haircut of 20%, which would act as sort of an insurance mechanism against future write-downs. If following the resolution process under that scheme there were additional funds, then the FDIC would have the authority to pay back, all or part of that 20% premium. But I thought that might solve out in the market this
Right.
presumption. Let me go through the two arguments I made during the conference committee. We didn't carry this argument, but I think it still holds true. First, there is this strong presumption that the regulators are going to err on the side of bailouts, especially for the most interconnected and largest firms that will likely get preferential treatment through the resolution process. With this understanding, creditors, and we're talking especially here about short-term creditors, those creditors, by the way, are going to be considered essential under the FDIC's proposed rule, right? So they're going to know that lending to these large, complex financial firms subject to the resolution authority is basically risk-free, or it's very close to that, because if these firms fail, creditors are going to be made immediately whole or very close to whole. And as a result, these firms are going to be able to borrow more cheaply, they're going to grow even larger, and they're going to become more significant, systemically significant. And that's going to compound the too big to fail problem. Now, there's a second problem also that arises. And that, to go back to it again, is the clawback provision. Once that money is out the door to creditors, it's going to be very difficult to recover. And I think that's, again, why you see this basis point difference. Bankruptcy over here for these firms versus resolution authority for the large ones. It is not hard to foresee a situation where a recently bailed out creditor strongly argues that handing over these sums may jeopardize their unstable firm. And this is an argument that regulators, having just bailed out these same creditors in the name of preserving financial stability, may find very difficult to resist. Additionally, there's no guarantee that a given creditor will be able to pay back the difference between the advances and what they would have received in bankruptcy under the bankruptcy code, and under this mandate. So, I'm just going to go to the Dallas Fed president, Richard Fisher, who recently said this about these arguments that I've made in the past. A credible big bank resolution process that imposes creditor losses will be difficult to enforce, especially when regulators are explicitly directed to mitigate disruptions to the financial system, as they are in the Reform Bill. So I understand that you believe regulators need broad authority to handle a crisis, but I think that the unintended consequences here have got to be considered. And if we were to look to tightening the language while working within the resolution authority mechanism, are there steps we can take to minimize the potential for abuse down the road? And the argument, the amendment I made earlier, does that hold water with you? Is there a way to get at that?
So a couple of things. We are all for tightening as much as we can. I think we do not want bailouts. We want market discipline back. As a deposit insurer, there's obviously moral hazard associated with providing deposit insurance for these entities that have insured banks. So we need market discipline to complement the regulatory process as a weapon against excessive risk taking. So whatever we can do to tamp this down, believe me, we will work with you. We are trying to do a lot of this through regulation. I think we put a rule out that basically said if you're over a year, forget it. Never going to be any differentiation. Please do not interpret that to mean that if you're under a year, you're going to get it, because you're not. They're very much subject to loss absorption there as well. I think one of the advantages with the government being able to provide liquidity is, for instance, if you had unsecured commercial paper, you could haircut that. Even though you would lose the funding, you could replace it with government funding, but absorb losses on those creditors. So I think the presumption for the short term should be they're taking losses too. Again, the only time I can see that that wouldn't happen is if the acquirer wanted to maintain those customer relationships. So, and you might then find that, for instance, with the derivatives book. If they want to buy the failed institutions derivatives book, maybe they don't want to, even if there's some counterparties that are unsecured or under collateralized, they're probably not going to want to bother with imposing losses on them. And we find that now with uninsured deposits. But that's going to be a mathematical determination. Whatever is going to maximize recoveries, that's what we will do. So I do think we want it narrow. We're trying to do, we think the statute does have some significant limitations. We're trying to tighten those even more with regulation. But I'm happy to look at language and talk with you about this further. Believe me, no more, there's no entity more so than the FDIC that wants to end too big to fail.
Thank you, Chairman Bair.
Thank you.